What if I told you that every time a banker calls you about a new account, a credit card, an investment, or a loan, they might actually be carrying a massive, invisible burden? I mean, think about it. Most people think banking is one of the most comfortable, prestigious professions out there, right? We picture air-conditioned offices, formal suits, fixed working hours, and really respectable salaries. But today, in this explainer, we're going to dive into the hidden mechanics driving the financial industry.
Because behind those polished counters and those super friendly, welcoming smiles lies a reality that very few people ever get to see. It is a world driven relentlessly by numbers. As customers, we usually only see a few minutes of a banker's day. What we absolutely don't see are the high-stress morning review meetings, the glowing performance dashboards, and the end-of-the-day reports happening inside those illuminated office windows long after the branch doors are closed for the day.
So today, we are pulling back the curtain on one of the industry's least discussed realities, the immense, often overwhelming weight of sales targets. It's a world where targets essentially dictate your success and where pressure just becomes woven into the fabric of everyday life. We're going to look at exactly how this pressure is engineered and, more importantly, how it ultimately impacts you. Section 1. The Engine of Pressure. Why targets exist. Now, before we just start criticizing the system, we really need to understand why it exists in the first place. Banks are businesses. Like any business, they require deposits to fund lending and sustainable profits to pay their employees. Without that growth, a bank simply cannot survive, expand, or invest in the digital technology we all rely on every day. And that is exactly why key performance indicators, or KPIs, exist. They're initially designed as completely neutral tools to measure this necessary business growth. On paper, measuring performance isn't inherently a bad thing at all. It's just standard practice.
The real question isn't whether targets should exist. The real question is this: when does healthy motivation mutate into toxic pressure? Because healthy targets absolutely can motivate staff, encourage incredible innovation, and actually improve your customer service. But in some workplaces, yesterday's remarkable top-tier achievement simply becomes today's baseline. One highly successful month just morphs into next month's absolute minimum expectation. And when this happens over and over, people stop celebrating progress and begin frantically chasing numbers.
Section 2. The Invisible Employee Burden. The Frontline Reality. And this isn't just an isolated, localized issue. It is a reality happening all over the globe. Listen to this stark confession from a Canadian bank teller with 15 years of experience. They said they were in survival mode, forced into an agonizing choice between keeping their job to feed their family or doing what's right for the customer. Let's be clear, the overwhelming majority of bankers genuinely want to help you. But when success is measured almost entirely by hitting numerical targets, even the most well-intentioned employees can feel completely trapped. Just imagine arriving at work on the very first day of a new month. Your inbox is already stuffed full of reminders, and you're staring at dashboards comparing your numbers to everyone else on your team. The psychological overload is incredibly intense. In an Australian survey of NAB employees, over 81% felt their unpaid hours just to meet these demands were totally unreasonable. Researchers actually call this a profound cultural fatalism. Work-life balance suffers, and the joy of serving customers just vanishes. We can systematically map out this cycle of pressure. Failing to hit your numbers doesn't just mean you miss out on a bonus track. Often it leads directly to being labeled an underperformer and being placed on a formal performance improvement plan, or PIP. Now, in a healthy environment, a PIP is for coaching. But in these toxic sales cultures, it's frequently just a formalized conveyor belt to daily micromonitoring, workplace harassment, or eventual firing. And if you think this sounds anecdotal, well, the data backs it up. A UK survey by the consumer group Which revealed that over half of bank employees face actual public shaming for missed targets. 58% had their individual sales broadcast to their entire team, and 52% literally had them pinned up on physical notice boards for everyone to see. In one truly bizarre, humiliating example from the findings, some branch managers were literally handing out cabbages to their underperforming staff. I mean, no way, right? But it happens.
Section 3. When customers pay the price. The spillover effect.
Pressure rarely affects only the employees. Eventually, this toxic internal culture spills right over the counter and directly onto the consumer. When bankers are pushed to the absolute brink, the entire nature of customer service fundamentally changes. A relentless sales-based culture, combined with these rigid staff incentive schemes, essentially forms the root cause of mis-selling and irresponsible lending. When the drive is purely about volume, banks end up pushing poor quality or totally unsuitable products onto consumers just to hit those required metrics.
Consequently, we start seeing a huge direct impact on the consumer. Have you ever wondered why you get repeated, annoying marketing calls for a credit card you definitely don't want? Or why vulnerable customers like seniors or new immigrants who naturally trust financial institutions are often pushed into unnecessary, fee-heavy products? It's simply because the conversation has shifted away from solving the customer's actual financial problem to the employee desperately trying to hit a quota to keep their job.
Section 4. Systemic risks and scandals. A threat to stability.
And listen, this isn't just about a few pushy sales calls at your local neighborhood branch. When an entire global industry prioritizes short-term quantity over long-term quality, the very foundations of the economy start to crack. Tracing the history, we can see how this aggressive push for short-term profits helped fuel the catastrophic 2008 global mortgage crisis. In 2016, we saw the massive Wells Fargo scandal, where millions of accounts were opened entirely without customer consent, just to meet impossible daily targets. And by 2019, the Australian Banking Royal Commission was sounding the alarm on the widespread damage caused by this forced selling.
Regulators worldwide have investigated these practices deeply, and there is a powerful quote from a UK regulator that perfectly encapsulates their findings. They stated that some incentive schemes were rotten to the core and made a bad problem worse. They concluded that these misaligned incentive schemes weren't just terrible for employee morale, they were a toxic driver of mis-selling that actively created the conditions for systemic financial meltdowns.
Section 5. Rebuilding trust in banking. Finding the balance.
So what do we do about this? How do we actually fix a system that relies on numbers but so desperately needs humanity? Well, the strongest organizations out there are recognizing this and dismantling those unrealistic KPIs. Building a healthy workplace means setting realistic goals. It means focusing on ethical, needs-based selling. It involves continuous learning and fostering teamwork rather than brutal, cutthroat internal competition. Above all, it means recognizing employees for the actual quality of their advice, not just the sheer quantity of products they can push.
Ultimately, it comes down to this. Trust is the absolute foundation of banking. Without trust, no financial institution can succeed over the long term. When employees feel respected, secure in their jobs, and totally free from the threat of public shaming, they invariably serve their customers better. And customers who trust their bankers remain loyal much longer. In the end, everyone, the bank, the hardworking employee, and you, the consumer, benefits.
So the next time you sit across the desk from a bank representative or receive a call offering you a brand new financial service, remember this explainer. That person sitting across from you is trying their best to balance your customer satisfaction with some incredibly demanding corporate expectations. Look beyond the polished suit and that professional corporate smile and ask yourself, what invisible burden might your banker be carrying today? Thanks for joining me, and keep questioning what's going on behind the curtain.